Right, good afternoon, good afternoon. Wait, I have the video up? My bad, fam. My bad, how we doing though, family? Hopefully everybody's good. We are 15 minutes out here from the interest rate decision from the Federal Reserve, and about 45 minutes away from hearing Mr. Powell's comments on their decision as well. Trading view open. Okay, I'm super prepared for the stream, obviously. 1 second here, family. Devin, what's going on, bro? You at work, tapped into certain events, I'm not active. That's okay, dude. It's okay, dude. Thank you for hopping on. We appreciate that. Alright, we got some trading view up here. Let me know if the music's... Let me turn this down a little bit more, but let me know if that's for some reason too loud. It shouldn't be, but in case it is. Alright, family. Again, we are about 13 minutes out right now from the interest rate decision. We are, or I am, I should say, and if you guys have a different opinion, feel free to drop it in the chat. But I am widely expecting this just to be a 25 basis point reduction in the interest rate here. And I'm expecting, we're getting some economic projections as well. So I'm going to be most interested in some of these projections, but I'm also going to want to hear some of Powell's thoughts specifically around the employment rates, right? The unemployment rate, more specifically. He'll probably mention a whole bunch of stuff about inflation and how we're kind of getting a handle on that now that we're sort of kind of below 3%, depending on what you're looking at, whether it's standard or core. Core being at 3.2% still. So it'll be interesting to see what his comments around that are, but more than anything, we want to hear about his labor market comments, specifically since unemployment's dipped a little bit last reading. So I wonder if they still think that they have a handle on that, and I'm also interested to see if any of their projection materials around that changed. Actually, let me see if I can pull something else up real quick. Oh, hold on here, let me see if I can pull up. Out of curiosity, I am curious to hear what you guys think about today's meeting, right? Do you guys think we get that 25? Do you think we get a 50? As I pull up the old economic projections here. Alright, let's see. Last time we had projections was in June. Alright, we'll pull up this for now. What's going on, Alex? Have you entered anything this week? Yeah, bro, we've taken trades. Not gonna review all my trades on stream for you guys. It's quite literally what the trade room's for. But yeah, obviously I've been trading. Alright, let me pull this up for you guys here too. Let me know if you guys are able to read this. Hopefully you guys can read that. If not, I could zoom it in a little bit more maybe. Without losing the data. Yeah, there we go. Yeah, sort of. Alright, so some things I'm looking to see whether or not they changed, man. Again, unemployment rate expectations. They still have this at about 4.2. Again, this is the these are the June projections, by the way. Still have this at 4.2. I still think this is wildly wrong. Whether or not they change this is going to be seen, but I think that they should. Again, we've already ticked up to 4.3. We're back down to 4.2. I don't think them cutting rates this one time is going to fix much about the labor market. I still think we creep upwards towards 5%. So I'm interested to see if they change any of this data. Again, whether or not they change the inflation, probably not. Again, they're pretty much under control with this. And then the second thing we'll be looking at is the plot graph here, and just seeing if anything changes in the sentiment for where they see what the average rate will be. Primarily in 2025, there might be some further out expectations about 2026 that are changed as well. Again, for 2025, we're looking at sitting about that 4%. Whereas, again, 2024, they're really only pressing in this, really just this one cut, maybe an additional one, as we talked about. Maybe we do September, skip November, do December. So I'm curious if any of this stuff here changes, primarily in the 2025 area. How many of these shift down below the 4% level, if any at all? I do believe we'll see some shift here. I do believe we'll see a better average closer to 3.5. Again, that's just my opinion, which also is going to shift probably 2026 down a little bit as well. So I'm expecting some plot graph changes here as well. Again, I don't really have an opinion too much on anything further out than that, but I do expect this to kind of tick down under 4 and this to tick down under 3. Again, inflation's under control. They're expecting inflation to stay under control, and especially if they don't expect unemployment to get much worse, if they stay with these expectations in the median category here at 4.2, and they really don't see this getting worse, I don't see why they can't move some of their expectations down here. So again, two things that we're going to be looking at. Again, I'm not going to really bother too much with the inflation data. We already know how that's going to come out. We already know that's pretty much under control. It's not really an issue for us. In terms of price action, I would like to see a spike up off the news. I would like to see everybody kind of get excited, everybody get happy, rate cuts are here, and then I kind of want to fade into that. There are some situations this morning which we analyze as just taking liquidity on both sides before falling. So again, we still kind of need this to give us a little bit of a push up. NASDAQ itself, I think, has way more room to the upside and potentially take 19,900 if the market wants to get super excited. In that case, I'm not really sure where the Dow ends up, because again, the Dow's at all-time highs, and structurally to the left, there's just nothing worth looking at. And there is nothing to the left, right, except this internal structure here. So it's going to be interesting to see what we get here. Again, I'm going to be, again, I'm already flat on everything in regards to my trading. I've already exited everything that I potentially took this morning and throughout the week. So I don't really have any risk here. I'm just looking to add on risk after the result. Again, preferably if things spike up. If things spike down and they play the direction which I assume we're going to resolve in by the end of the week, well, then I will just have to play continuations, you know, later in the week. I'm not going to gamble or chase anything today. It's not my prerogative. What's going on? Free Zone Lou, Bitcoin Mommy, what's up? See y'all in chat. Who's writing in the Discord here today? Oh, somebody asked me if we were streaming. We are streaming, Justin. Hopefully you're on. Or Martin. I'm sorry, misread your name. Alright, we got 6 minutes here. You're pretty quiet in chat, so I'm gonna just let the music vibe out and play this, let this music just play out until results. Happy FOMC? Yes, happy FOMC, brother. Sniper, don't forget what I'm gonna ask you tomorrow, bro. Don't forget what I'm gonna ask you tomorrow, bro. Don't blow that account. I'm telling you, you blow that account, bro, I'm gonna have to remove your typing privileges. So you better hope it's not already blown. If you were smart, you would have not even activated it. Honestly. After I told you that, if you were smart, you would have just not even paid for it. Yeah, man, we'll see what we get here. Hopefully I get what I want. I could do some executions here in front of your guys' face. That would be pretty cool. I doubt we'll get that, but you never know. I'm gonna do a quick run through of Twitter real quick, see what some of the sentiment is. I know a lot of people are bullish today, which is why I'm looking the other way. Let's see, the Kabasi letter says, our premium subscribers are notified about the S&P 5. Okay, nobody cares about that, brother. Now cashing in plus 230 points. Okay, we'll care about that, though. Alright, X is surprisingly quiet right now. 4 minutes left to go. Surprisingly quiet. Still some talks about the disparity between what prediction markets are expecting and what central banks are expecting. I'm pretty sure every central bank is expecting a 25 basis point cut. I think JP Morgan is expecting a 50. I think the only central bank, if I read if the information I read earlier was correct, I believe they're the only central bank calling for 50. And as I've told you guys, I think they should do 50. However, I don't believe that they actually do. So I think JP Morgan's kind of just playing that devil's advocate spot where it's like, okay, you know, everybody knows the 25 is coming. You know, let's be the central bank that roots for the 50. So I think that's kind of what's going on there. But they should do 50 in my opinion, if they really want to. If they want to get the labor market under control quicker, they would do 50. It would definitely throw a wrench into the bullish trend of indices, because people are going to think that the Fed is expecting a recession a little bit sooner, quicker, maybe more intense. So 50 wouldn't be the best thing in terms of price action for everybody. Well, for the bullish people anyway. What's Dom writing in chat? What's going on, Dom? I feel like I'm seeing a lot of people bearish. Really? I mean, honestly, I'm seeing both. I know you and Acro have shared the whole, you know, oh, they're cutting rates again like 2008. Again, I don't think, or 2007, whatever it was. I have seen those posts, but it depends on who you're listening to. When I say most people are expecting bullishness, I'm not talking about people with a brain on them that are using like data. I'm talking about like just the idiots on Twitter, like the average everyday person. There are a few people that are signaling, oh, it's like 2007, 2008. Those people I think are still too far one way. Like they're calling for something way different than I am. I'm calling for like a temporary pause here, right? This is what I'll show you guys structurally what I'm looking for. I can use NQ as an example. I'm just looking for this to do this over the next couple of months. Ideally, I get that. I probably don't. But I'm looking at us taking out at this 17,400 level. And then this is when all the recession people are like, oh my fucking god, we're gonna enter a recession. It's like 2008. And then at that point, I will be a buyer again. So I'm not as big on the panic as those people. But they are out there, man. They are out there. I'm hearing bearish of 0.25, bullish of 0.50 on X. That's backwards, in my opinion. I think if you get 0.25, even if the reaction is down, we probably still get some bullish weeks. If we do 0.50, I don't think we have a shot at resolving bullish over the next couple weeks. I really don't, but I could be wrong. Alright, we got 30 seconds here, and then I'll dive into some of the data. I'll take a look at what the reality is of the market. It's good, fam. 0.50 incoming. Yeah, I'm honestly not on retard Twitter. Need to have a burner for it. Just do what I do, bro. Just reply to all the stupid people, and then more stupid people show up on your feed. It's wonderful. You gotta love the algorithm. Alright, 5 seconds here. Let's see what the reaction is here. I'll also pull this up real quick. And okay, we're getting interesting reaction. What did they do though? Can I see a number? Okay, moving up, took in that liquidity. Awesome. God forbid you guys give me a number. Why I didn't have a terminal open, it was besides me. What did they do? What did they do? What did they do? Why can't I get a number? Why can't I get a number? Why is there no number anywhere? Okay, here we go. What's going on, dude? Wow, they did a 50. Are you fucking serious? Wow. They actually did the 50? Is this... Hold on, let me pull up the official report. They actually did the 50. No way. Hold on, let me, where are you guys at? Hold on, let me pull this up for you guys. Wow. That's honestly pretty fucking surprising. I'm surprised Powell had the balls to do this. Oh, look, they upped the unemployed. Okay, yeah, he's gonna cite this. Yeah, look, 4.4, look, 4.4 even for this year. 4.4 for 2025, beautiful. Core PCE inflation estimate revised down. No change for 2025 based off my knowledge. Wow, they really had the balls to do the 50. That's nutty. Okay. Plot graph. Like, as we said, like this came down to about 3 points. This is a little bit lower than I thought. Wow. Okay. They did the 0.50, so I guess that makes sense. Wow, I really can't believe they did that. Average under 3% here. Let me see if there's anything in the statements up here. I really can't believe they did that. I'm happy they did, but wow. Wow. Okay, let me go see what NASDAQ is doing real quick. We take out 19,900? Oh, we just missed it. Wow. Okay, cool. So, a couple great things to see here. One, we got a pump, so I love that. They did 50, which means that they know on the unemployment. They're trying to get ahead of this unemployment issue. Again, I think it's still too late. The 0.50 is pretty fucking bold, though. Shout out to Powell, man. I really did not think this boy would have the balls to do that. That's crazy. Oh man, I can't wait to hear him speak. All right, let's go take a look at charts real quick. There's nothing else in this data I want to take a look at. All right, this is best case scenario right here. Yeah, we push up. I'm telling you guys right now, we push above 19,920 off some Powell statements, and your boy's probably gonna go short. I almost want to just fade this, but I know that's dangerous when he's speaking. Oh yes. Oh, I'm so excited. What's the dollar index doing? Yep, dollar index pushed below 100 as we discussed this morning as well in the live stream. Again, I think this 99 is a little bit out of the question. Let me just take a look at gold real quick. Gold is still playing internally. Alright, yeah, I'm excited. This just made my day. Oh boy, I'm so excited. Let me see. Need to see what point. Mick, I can't believe you were right, brother. Shout out to you, man. I really can't believe Powell had the balls to do that. Please just don't fade off without me. Alright, hold on. Let me send this real quick. Actually, you know what? I'll do this after Powell speaks. Told you so. Yeah, you did. I mean, listen, like I said, bro, I think it's why. I think this is a good decision. Like I said, I really think they should do 0.50. I really didn't think they would do it, though. Based off their statements, man, this is a little bit of a shock of tonality, in my opinion. But I'm happy to see that move. I'm happy to see this reaction. I'm happy to see that we're not just closing above everything. Again, gold with the potential absorption inside of here, I still think that we close under 25.45. And I know there's some people on here that are like, oh, isn't this news bullish? Isn't this news bullish? You'll find out over the next coming weeks on why it's not breaking it down right now. As we wait for Powell. I took a NAS short. Why? Okay. Sniper, all I'm saying, bro, is if you lose that account because you're shorting too early, I'll block you for 2 months. Wow. Alright, man. I'm excited to hear what Powell's got to say. Let me pull up a live stream real quick. Let me get that all sorted so we can watch him. I would love some thoughts from people that are in the trade room. Or if you guys are just watching randomly on YouTube and you're new here, well, welcome. We don't typically do public streams, but for the big news events, we do. Let me just search Powell live. Let me pull up. Who do we want to watch? Bloomberg? I'm break even, up $500. You're up $500 on that little of a move? I don't know, bro. Again, I'm gonna just let you do your thing, Sniper. I'm getting to the point, bro, where I'm gonna just let you make mistakes. I know you're already break even, but I'm curious what prompted you to take a trade before we took liquidity with no execution models within 2 minutes after news. Really, like, sometimes, man, you do things that just shock me. Outlook on crypto based on rate cuts. Well, my outlook on crypto is a little bit similar to the indices, right? We probably reacted to the buy side. However, I'm still following the path that I had laid out last time we talked about this. So the last time I did a public stream, I don't know, you guys can just go to my channel, go to live. Last time we talked about it was over here. We discussed it, you know, taking liquidity and then moving up towards the 61K level. Again, this is like worked nearly perfectly. Like we've taken this out. Again, I see this much like gold. I see this correcting down. I probably, and again, understand when I say this, please understand this before anything. My bags are already packed on crypto, right? I have no desire to acquire more unless I get a really, really good price. And none of this is really good pricing for me. So I don't have a vested interest in this, but I probably wouldn't be buying above 55.5. However, I still think we come out and take out this low at 52.5. So again, this is a little exaggerated. This is like best case scenario, but I think we get something like this before we continue higher. So again, are rate cuts good for crypto? Yes, in the long term, rate cuts are fantastic for crypto. They're fantastic for indices. They're fantastic for most markets, to be honest, besides the US dollar, right? Because essentially what's happening is now money is becoming cheaper, more accessible, it can flow easier, right? However you want to describe what happens when you reduce interest rates. And when money becomes cheaper and more accessible, then people can, you know, get funding easier in terms of companies and, you know, in terms of people getting money to allocate towards things like crypto. Again, however, especially when you look at like indices, it's no secret to anybody that they were going to cut rates today. Look, this shit's already fucking fading off. Son of a bitch. Alright, we'll have to hope Powell draws this back up. But it's the same idea, man. It's like, now that the news has come out, right, now that the rate cut is here, you're gonna get a bunch of people that funnel in. This is exactly why I'm looking at things like shorts on a day that some people would be like, why are you looking for shorts when we cut rates? Again, because the average everyday person is gonna wake up tomorrow and they're gonna see the headlines of today. Fed cuts interest rates for first time in 4 years by 50 basis points. What does that mean for you? And they're going to highlight all the reasons why that's good for markets and all that. All those people are going to funnel into shit, essentially at highs. I mean, again, look at the Dow. We're literally at all-time highs. This is climactic news. This is where all the dumb people get in. And I say that with as much respect as I could possibly say that, right? This is where all the dumb people get into buying. Indices have been very fucking bullish for a long time now. Quite literally years. At this point, 2.5, close to 3 years. So indices, and again, and crypto, I think over the course of the rest of the year, do take a hit. They do take a hit just to flush out those people that are buying those headlines, right? People funneling into this, that's not going to be sustainable. We'll fall back to like 42, or not 42, I'm sorry, 52. Play with inside of this little pocket of money, and then from there we'll continue higher. So whether it's crypto, whether it's indices, I see the same thing happening, right? Corrections in all these markets until the dumb money is flushed out, which is most likely to happen where the best buying is to occur, which on NASDAQ is about 17K, which for crypto, for Bitcoin, again, if I was really trying to accumulate this, I'd probably try to get under 55, but ideally under 52 is like best pricing you could probably look for. Again, maybe we fill this out at 50. There's a chance of that. Kind of have to see how we respond as we begin to move down before I come up with that. But yeah. Let me see. Hello, what's your view on gold right now? Again, bro, same thing as everything, bro. At this point, like I've said, we talked about this morning. I know you probably weren't on this morning's stream, Mick, because I didn't see you in chat. And now that we've taken out this high again, I'm telling you, it's my opinion that within the next 7 days, we'll probably be trading below 25 45. So again, as Powell begins to speak in a little bit, again, I'm hoping Powell can push us up a little bit, fill out some wicks, and then we could try to short. And me personally, I'll be looking to short I'll probably try to short gold. I don't even know. This is gonna be a tough decision for me, honestly, because the Dow is already moving. This might be tough to grab. Yeah, probably NQ. I mean, ideally NQ takes out this liquidity, which it might not. But yeah, ideally I'm gonna try to short NQ and gold. It's really whichever one I can get the best risk to reward on, the best price. Gold is a little bit easier for me to hold overnight based on my account balance too, so it just requires less margin from me. So ideally probably gold. You know, this is fantastic though. This is probably the best type of response we could have got. This boy Mick shared something in fucking Dutch in the Discord, bro. I gotta get ChatGPT to translate this, bro. I don't read Dutch. Translation, please. I'm in short gold. Yeah, I'm gonna wait till Powell speaks, bro, personally, because Powell has a habit of filling out these wicks. Again, indices are already moving, which is really annoying, but again, I'm not gonna do anything until Powell speaks. I want to hear what he has to say. I shared it in WhatsApp with my girlfriend. Oh, okay. So calf already, stop loss at break even. Alright, I mean I can't be mad at that. Don't know how much money you really could have made. There's a little move, but just check a few other crypto pairs real quick for some price levels. Yeah, Ethereum is in no strength whatsoever, huh? Yeah, this might even push below 2K. I'd maybe take out this. It's hard to say where this is gonna stop past that. There's really nothing that clear over here. Like, yeah, there's the reaccumulation you can play under, but nah, it's very choppy. Yeah, I'd want to see what happens under 2100 on ETH. Again, anything under 2100 is gonna be a good price. There's really no reason to try to hit that to the point. "15-second charts." Oh yeah, you bold. I won't play below the 1 minute. Even the 1 minute is not. I don't even prefer it. Again, I know people play them. I know people can play them. You know, there's a lot of successful traders that do play under the 1 minute time frame. I just the reaction time you need and the decision making process you gotta go through is just too fast for my liking. Not even that I couldn't do it, it's too quick for my liking. Waiting on your NQ call? Yeah, well, again, as if we fill this wick, I'm probably gonna end up going short. But here's the thing, Alex. Here's the real thing you'll need to understand is forget about me even executing today. Executing today is irrelevant. What y'all need to understand is the implications of this entire move. That's what you need to like. You just need to keep this in mind while you're reading all those headlines and everything else. Don't worry about catching the perfect trade like up here today. It's like, even if you end up going short, you know, again, like let's say we fill the wick here, just push it out of the way. You fill the wick and this like sells off today, and then you know, you do something like this. It's like you can get short at like any other sort of rally or execution model or market structure that you don't have to get the perfect entry today. Today is all about setting ourselves up for the next 3 to 5 months. Yeah, exactly. See, free zone elusive. The big picture play is what matters. The people that are trying to make $1 million today are just degenerate gamblers. Matt, what's going on, bro? I saw your message in the Discord, bro. Not gonna put your business out there, but if there's anything you need, man, you just let me know. And obviously take all the time you need and all that stuff. And, you know, my condolences. But good to see you active in chat, at least for the time being. Very likely we'll wait for the low volume move up at Asian Open, then short tomorrow like FOMC. Yeah, again, it all depends on how we resolve through Powell. It's possible we stay elevated and, like you said, we wipe some of this during Asian session. But we're going to be on the lookouts the next 24 to 48 hours for short entries. And again, we have Powell coming up in about 15 minutes. We are going to watch the speech. I will stay relatively quiet during the speech unless he says something that I need to highlight or express the importance of. Gold pushing higher. Okay. I'm just going to pull up. Pull this up again real quick. Alright, so this is our new expectations here. I want to see what else subtly changed here. Yeah, so PCE inflation 2.6, we dropped it from 2.8. Yeah, from 2.8. The unemployment rate's the only thing that really changed. PCE inflation changed a little bit as well, but again, inflation is no longer an issue. We've been saying that for a couple months, right? For those of you that are watching the Fed closely, that the Fed is no longer paying attention specifically to inflation, and they haven't been for a couple meetings now. At this point, this will be like the third meeting that it has not mattered.
Come with me on this journey. I hit home in that base.
They didn't change anything about GDP though, huh? GDP is expected a little bit of a decline in GDP. Central tendencies unchanged mostly. This is 2, 4, 6, 8, so 9 at above 4%. And we have 2, 4, 6, and then 12 now sitting in the 3.0 to 3.25% range. So that's what's that? It's a 75 basis point difference in expectations. So if we're gonna be at 3%, I'm trying to just figure out the path, right? So if we're gonna be at 3% in 2025, we're at 5% now. I wonder, do they skip November? Here are some of my thoughts, right? Here are some of my thoughts. So we did a 50 basis point cut here in September. So like what becomes of November then? Right? Like another 50? I think that's unlikely. I think they did 50 now. I think it's likely that we do nothing in November. Right? So do nothing November, cut December. I think this is the path. I don't think we do anything in November now. So if we cut another 50 in November, we'd be down to 4.5. Let's just say we stay that path, which we probably wouldn't, but let's say that we do. You have 4% by December, so how do you get to 3% in 2025? You don't. There's too many meetings. You'd have to pause somewhere. Even if you did 25 in December, you're at 4.25. Yeah, I think we do nothing in November. I think that's it. I think that's likely. Yeah, I think this is the path. I think I had it right when I tweeted that. I had the what did I tweet? Hold on, let me see here. I be posting so much, I be forgetting what I'm posting sometimes. Let me go to search. I can't search. Never mind that. Bro, do you ever watch M2 Money Supply? Yeah, I mean, when it's necessary to. I mean, like, if you're watching an M2 Money Supply chart every week, then you're wasting your time, but the coin is 98%. All assets are correlated with that, bro. As monetary supply expands, prices go up. That's not a miss. I know what it looks like. I looked at it like 2 days ago. It's slightly increasing, which we know because they printed some money. But it's like that's all assets, bro. Remember this statement. If you can remember this statement, this is why we always say time in the markets is better than timing the markets. As long as monetary supply is increasing, which it always is, it's never not increasing. I mean, like in the macro, obviously we tighten up and do shit like that, but monetary supply is always increasing. That's how fiat currency works. They print more of it when they need it, right? So that's why asset prices are always bullish. The more monetary supply you have, the more anything can cost, because the more money is available to flow into anything at any given time. So it's like, yeah, when you see that happen. But again, like, the monetary supply is gonna have its little fluctuations like that. Gold hitting 2600. Powell ain't even talk yet. Is gold still pushing crazy like that? Yeah, it is. Okay. By the way, gold's already above 2600. Use futures pricing. Don't use CFDs. CFDs are trash. If you guys are still trading on Forex brokers, please stop. Yeah, 25, yeah. Get off the CFDs. Alright, we got 5 minutes here till Powell, and then I'll shut my mouth, and we'll listen to the big man speak. And you missed UJ again? Nah, I don't think so, bro. Is this doing what we talked about? Yeah, don't worry about this. Don't worry about this. This will be back above 147, I think, soon. Actually, you know what we have to actually be careful, because as long as these guys don't increase their interest rates again, which they said they would not do until the new year, and I haven't heard otherwise since, we might be able to see a recovery in UJ. So don't stress that too much. EU triggered, by the way, if you guys were paying attention this morning. Again, we talked about how this is probably going to fill the wick off the news, and then come take out the loan candle, and then from there you can play it down to the 110.80. So, again, will that happen? Find out in a couple weeks. I don't know. Some of you guys probably won't even be here by then. But take a screenshot and feel free to call me out on social media if it's wrong. Highly doubt it's wrong. Do you have your own futures account that isn't a prop? I do. I have two. My recommendations for you on futures accounts that are not prop firms would be TradeStation if you have a decent amount of capital. And when I say decent amount of capital, I mean like you better have like 3 to 5 grand at the minimum. Otherwise, you're not even gonna be able to trade really. Especially holding overnight. You won't be able to trade overnight. If you have smaller capital, then you can use AMP futures, or if you're trying to hold overnight, then I would also recommend AMP futures because the margin requirements for overnight are 1/10 of that from TradeStation. Damn, I was thinking at least a 10k account. Yeah, for TradeStation, I mean, the more you have, the better. I'm just saying, like, without at least 3 to 5 grand, you can't even execute on TradeStation, like, at all, unless you're trading maybe ES, maybe. So, and the reason I have to stress that is because a lot of people are used to like Forex brokerage where they could deposit $100, $500, and like that's just not gonna work on TradeStation, right? So you need at least 3 to 5k. If you have 10k, even better, you know. What is this song that we're listening to right now? We don't have to skip this. Actually, it don't matter. Powell coming up soon. I want to eventually load up on a futures account. Safe side trading plus trading view. Trading looks beautiful. I don't know what you mean by safe side trading. I don't know if that's like a broker or something, but yeah, man, either AMP futures or TradeStation. I've had no problems with either. With the exception that the Quant Tower application I was using with AMP, I thought was good at first, but then it just became a headache. So, but like it isn't. Oh, I got you. Like safer than CFDs. Got you. All right. Powell up in 2 minutes here. If you guys have anything else for me, let me know. If not, I'm gonna put his face and mouth up on stream here. Let me just prepare that as well. I'm gonna turn off the music for now because I have to move Mr. Powell over to that screen so I can share that.
Key questions.
How do you expect him to frame it? Is this a will regroup in November, or is this the beginning of a one-way trip back towards what they think is neutral?
Could it be both? I mean, right? Is there's basically, can everyone have their cake and then eat it too? Because essentially you have inflation coming down and you have...
hold on, what did Devin say here? I have a question, brother. I have a funded account this morning, but I also had another account as well that wasn't traded on yet. Hold on. Blew the funded account, but I'm up 6,500 on the other account. Give me some tips that I can use without you knowing. Oh, with you knowing what kind of trader I am. I had a funded account this morning, but I also had another account as well that wasn't traded on yet. Blew the funded account, but I'm up 6,500 on the other account. Okay, so for one, here's a very simple question: is like, why are you ever trading with so much risk that you can blow your account in one day? That's question number one. Maybe that's not what happened, but that would be my first question. Hold on, let's let Powell speak. Devin, DM me, bro. I'll help you in private so I can ask more details about that.
Focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people.
Where's Mr. Powell's face? Where's his face?
Our economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state. Inflation has eased substantially from a peak of 7% to an estimated 2.2% as of August. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a 0.5 percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.2% in the first half of the year, and available data point to a roughly similar pace of growth this quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment fell back in the second quarter after rising strongly in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of 2% over the next few years. In the labor market, conditions have continued to cool. Payroll job gains averaged 116,000 per month over the past 3 months, a notable step down from the pace seen earlier in the year. The unemployment rate has moved up but remains low at 4.2%. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggest that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year, 0.4 higher than projected in June. Inflation has eased notably over the past 2 years, but remains above our longer-run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.2% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 2.7%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.3% this year and 2.1% next year, somewhat lower than projected in June. Thereafter, the median projection is 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. For much of the past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight. Our primary focus had been on bringing down inflation, and appropriately so. We are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our restrictive monetary policy has helped restore the balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remain well anchored. Our patient approach over the past year has paid dividends. Inflation is now much closer to our objective, and we have gained greater confidence that inflation is moving sustainably toward 2%. As inflation has declined and the labor market has cooled, the upside risks to inflation have diminished and the downside risks to employment have increased. We now see the risks to achieving our employment and inflation goals as roughly in balance, and we are attentive to the risks to both sides of our dual mandate. In light of the progress on inflation and the balance of risks, at today's meeting, the committee decided to lower the target range for the federal funds rate by a 0.5 percentage point to 4.75% to 5%. This recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we begin the process of moving toward a more neutral stance. We are not on any preset course. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025. These median projections are lower than in June, consistent with the projections for lower inflation and higher unemployment, as well as the changed balance of risks. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation back down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Steve Leisman, CNBC. Thank you, Mr. Chairman, for taking our questions. In July, you said you weren't necessarily thinking about a 50. You didn't want to be specific, but you said you weren't thinking about a 50. The inflation data last week came out a little firmer than expected. Retail was strong, third quarter GDP running 3%. So what changed and made the committee go 50, and how do you respond to the concerns that perhaps it shows the Fed is more concerned about the labor market? And I guess, should we expect more 50s in the months ahead? And based on what should we make that call? Thank you.
So, okay.
Actually, a pretty good question.
Let me jump in. Since the last meeting, we have had a lot of data come in. We've had the two employment reports, July and August. We've also had two inflation reports, including one that came in during blackout. We had the QCEW report, which suggests that suggests that the payroll report numbers that we're getting may be artificially high and will be revised down. You know that. We've also seen anecdotal data like the Beige Book. So we took all of those and we went into blackout and we thought about what to do, and we concluded that this was the right thing for the economy, for the people that we serve, and that's how we made our decision. So that's one question. What was the second and third?
How do we make sorry, thank you, sir. How do we figure out in the months ahead, is there another 25 or 50 coming in? Based on what shall we make that call? Thank you.
Sure. So a couple things. A good place to start is the SEP, but let me start with what I said, which was that we're going to be making decisions meeting by meeting based on the incoming data, the evolving outlook, the balance of risks. If you look at the SEP, you'll see that it's a process of recalibrating our policy stance away from where we had it a year ago when inflation was high and unemployment low, to a place that's more appropriate given where we are now and where we expect to be. And that process will take place over time. There's nothing in the SEP that suggests the committee is in a rush to get this done. This process evolves over time. Of course, that's a projection. That's a baseline projection. We know, as I mentioned in my remarks, that the actual things that we do will depend on the way the economy evolves. We can go quicker if that's appropriate. We can go slower if that's appropriate. We can pause if that's appropriate. But that's what we were contemplating. I would point you to the SEP as just an assessment of where of what the committee is thinking today, what the individual members, rather, of the committee are thinking today, assuming that their particular forecasts are realized.
Go to Chris.
Hi, Chris Rugaber at Associated Press. Thank you. The projections show that the Fed officials expect the Fed funds rate to still be above their estimate of long-run neutral by the end of next year. So does that suggest you see rates as restrictive for that entire period? Does that threaten the weakening of the job market that you said you'd like to avoid? Or does it suggest that maybe people see the short-run neutral as a little bit higher than Thank you.
I think the way I would really characterize it is this. I think people write down their estimate, individuals do. I think every single person on the committee, if you ask them what's your level of certainty around that, they would say there's a wide range where that could fall. So I think we don't know. There are model-based approaches and empirically based approaches that estimate.
Just a heads up for anybody that's in the Discord, I sent a trade I took on my personal accounts. So go reference the trade section if you guys want to check that out. That's the only position I've taken so far.
Looking at the way the economy reacts to that, and that'll be guiding us in our thinking about the question that we're asking at every meeting, which is our policy stance the appropriate one? We know, if you go back, we know that the policy stance we adopted in July of 2023 came at a time when unemployment was 3.5% and inflation was 4.2%. Today, unemployment is up to 4.2%. Inflation's down to a few tenths above 2. So we know that it is time to recalibrate our policy to something that is more appropriate given the progress on inflation and on employment, moving to a more sustainable level. So the balance of risks are now even. And this is the beginning of that process. I mentioned the direction of which is toward a sense of neutral, and we'll move as fast or as slow as we think is appropriate in real time. But what you have is our individual accumulation of individual estimates of what that will be in the base case.
Howard.
Howard Schneider with Reuters. How close was this in terms of the decision? You do have the first dissent by a governor since 2005, I think. Was the weight clearly in favor of a 50, or was this a very close decision?
I think we had a good discussion. If you go back, I talked about this at Jackson Hole, but I didn't address the question of the size of the cut, left it open, and I think we left it open going into blackout. And so there was a lot of discussion back and forth, good diversity of division, excellent discussion today. I think there was also broad support for the decision that the committee voted on. So I would add, though, look at the SEP. All 19 of the participants wrote down multiple cuts this year, all 19. That's a big change from June, right? 7 of them wrote down 3 or more, 17 of the 19 wrote down 3 or more cuts, and 10 of the 19 wrote down 4 or more cuts. So, there is a dissent, and there's a range of views, but there's actually a lot of common ground as well.
Follow up to that, now that this is in the books, can you give us some guidance as sort of follow up to Steve on the pacing here? Would you expect this to be running every other meeting once we get into next year? For example?
We're going to take it meeting by meeting. As I mentioned, there's no sense that the committee feels it's in a rush to do this. We made a good, strong start to this, and that's really, frankly, a sign of our confidence. Confidence that inflation is coming down toward 2% on a sustainable basis. That gives us the ability. We can, make a good, strong start. But and I'm very pleased that we did. To me, the logic of this, both from an economic standpoint and also from a risk management standpoint, was clear. But I think we're going to go carefully, meeting by meeting, and make our decisions as we go.
I'm interpreting this as there's no November cut. They came out strong, and they want to see how the data responds. That's exactly what that means. I highly doubt they do anything in November. I'm gonna keep listening for other clues, but that tells me we're on the right path. Cut this time. Again, they did stronger than I thought they would have the courage to do, but they did it nonetheless. And I think they're gonna stop in November with a potential another 25 in December. I'm unsure if they'll do 50 again in December as of right now. It's really gonna be data dependent. If unemployment continues up, then they maybe do another 50.
With our policy move today is to keep it there. You can say that about the whole economy. The U.S. economy is in good shape. It's growing at a solid pace. Inflation is coming down. The labor market is in a strong pace. We want to keep it there. That's what we're doing.
Sorry, Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, does today's action constitute a catch-up in action given recent substantial revisions to the employment data? Or is this larger than typical rate cut a function of the elevated nominal level of the policy rate such that an accelerated cadence could be expected to continue?
Okay. Multiple questions there, but so I would say we don't think we're behind. We do not think we're behind. We think this is timely, but I think you can take this as a sign of our commitment not to get behind. So it's a strong move. Sorry, your other question was?
Well, is this about what happened in the employment data between this meeting and the last meeting, or is this about the level of the funds rate, the high nominal level of the funds rate?
It's about the employment data. Dumb question. It's about the employment data.
I think it's about, we come into this with a policy position that was put in place, as you know, I mentioned in July of 2023, which was a time of high inflation and very low unemployment. We've been very patient about reducing the policy rate. We've waited. Other central banks around the world have cut, many of them several times. We've waited, and I think that patience has really paid dividends in the form of our confidence that inflation is moving sustainably down to 2%. So I think that is what enables us to take this strong move today. I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen. So in the base case, what you see is look at the SEP. You see cuts moving along. The sense of this is we're recalibrating policy down over time to a more neutral level, and we're moving at the pace that we think is appropriate given developments in the economy in the base case. The economy can develop in a way that would cause us to go faster or slower, but that's what the base case says.
And if I could follow up on the balance sheet. In 2019, when you did the mid-cycle adjustment, you ceased the balance sheet runoff. With a larger cut today, should there be any signal inferred about how the committee would approach end state on the balance sheet policy?
So in the current situation, reserves have really been stable. They haven't come down. So reserves are still abundant and expected to remain so for some time. As you know, the shrinkage in our balance sheet has really come out of the overnight RRP. So I think what that tells you is we're not thinking about stopping runoff because of this at all. We know that these two things can happen side by side. In a sense, they're both a form of normalization. And so for a time, you can have the balance sheet shrinking, but also be cutting rates.
Colby.
Thank you. Colby Smith with the Financial Times. Just following up on Gina's question on rising unemployment, is it your view that this is just a function of a normalizing labor market amid improved supply, or is there anything to suggest that something more concerning perhaps is taking place here, given that other metrics of labor demand have softened too? And I guess in direct follow-up to Gina is, why should we not expect a further deterioration in labor market conditions if policy is still restrictive?
So I think what we're seeing is clearly labor market conditions have cooled off by any measure, as I talked about in Jackson Hole. And but they're still at a level. The level of those conditions is actually pretty close to what I would call maximum employment. So you're close to mandate, maybe at mandate on that. So what's driving it? Clearly, payroll job creation has moved down over the last few months, and this bears watching. By many other measures, the labor market has returned to or below 2019 levels, which was a very good, strong labor market, but this is more sort of 2018-17. So the labor market bears close watching, and we'll be giving it that. But ultimately, we believe, with an appropriate recalibration of our policy, that we can continue to see the economy growing, and that will support the labor market. In the meantime, if you look at the growth in economic activity data, the retail sales data that we just got, second quarter GDP, all of this indicates an economy that is still growing at a solid pace. So that should also support the labor market over time. So, but again, it bears watching, and we're watching.
And just on the point about starting to see rising layoffs, if that were to happen, wouldn't the committee already be too late in terms of avoiding a recession?
So our plan, of course, has been to begin to recalibrate. And as you know, we're not seeing rising claims. We're not seeing rising layoffs. We're not seeing that, and we're not hearing that from companies that that's something that's getting ready to happen. So we're not waiting for that, because there is thinking that the time to support the labor market is when it's strong, and not when you begin to see the layoffs. There's some lore on that. So that's the situation we're in. We have, in fact, begun the cutting cycle now, and we'll be watching, and that'll be one of the factors that we consider. Of course, we're going to look at the totality of the data as we make these decisions meeting by meeting.
Just to address this comment in chat that says from SS, wonder if they could do a 25 basis point cut in both November and December to give confidence that they're in a cutting cycle. That could be a possibility. If they don't skip November, if they skip November and go right to December, I think they just do another 50 in December. But they could slow roll it like that too. The thing with me though is like and I'm gonna turn these guys off for a second here. Let me see. Can I swap this over to this real quick? Yeah, let me swap this over. My thing is, again, they have the rate here at between 5 and 4.75. So technically, by their own dot plot here, I really don't see how they're calling for another 50. But again, maybe this is a little misleading as of right now, potentially. But it's gonna be interesting to see how they go around that. Whether they do a skip and then a 50 or just 225s.
To the labor market, since you forecast we are going to see higher unemployment, and it is going to take a significant amount of monetary easing to just maintain it.
So, what I would say is we don't think we need to see further loosening in labor market conditions to get inflation down to 2%. But we have a dual mandate, and I think you can take this whole action as take a step back. What have we been trying to achieve? We're trying to achieve a situation where we restore price stability without the kind of painful increase in unemployment that has come sometimes with disinflation. That's what we're trying to do. And I think you can take today's action as a sign of our strong commitment to achieve that goal.
Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. You're describing this view that you don't think you're behind when it comes to the job market. Can you walk us through the specific data points that you found to be most helpful in the discussions at this meeting? You've mentioned a couple, but would you be able to walk us through what that dashboard told you as far as what you know about the job market now?
Sure. So we'll start with unemployment, which is the single most important one probably. You're at 4.2%. That's, I know that's higher than we were used to seeing numbers in the mid and even below mid threes last year. But if you look back over the sweep of the years, that's a low. That's a
was that the one from June I pulled up? LOL. I'm such an amateur. Hold on, let me go back.
Is a good labor market. So that's one thing. Participation is at high levels. It's
You're right. That was the one I pulled. Okay. Yeah, I'm an idiot. All right, that's what I get for having two tabs open. All right. Yeah, you're right. Ignore my last comment then.
Above what would be their wage increases, rather, are still just a bit above where they would be over the very longer term to be consistent with 2% inflation, but they're very much coming down to what that sustainable level is, so we feel good about that. Vacancies over, per unemployed is back to what is still a very strong level. It's not as high as it was. That number reached 2 to 1, 2 vacancies for every unemployed person. As measured, it's now below around 1, but that's still a very good number, I would say. Quits have come back down to normal levels. I mean, I could go on and on. There are many employment indicators. What do they say? They say this is still a solid labor market. The question isn't the level. The question is that there has been change particularly over the last few months, and so what we say is as the risks, the upside risks to inflation have really come down, the downside risks to employment have increased. And because we have been patient and held our fire on cutting while inflation has come down, I think we're now in a very good position to manage the risks to both of our goals.
And what do you expect to learn between now and November that will help inform the scale of the cut at the next meeting?
More data, the usual. Don't look for anything else. We'll see another labor report. We'll see another jobs report. I think we get a second jobs report on the day of the meeting, I think. Or no, on the Friday.
Oh, that should be real fun.
And inflation data. We'll get all this data. We'll be watching. It's always a question of look at the incoming data and ask what are the implications of that data for the evolving outlook and the balance of risks, and then go through our process and think what's the right thing to do. Is policy where we want it to be to foster the achievement of our goals over time? So that's what it is, and that's what we'll be doing.
Thanks. Hi, Chair Powell. Neil Irwin with Axios. We've only been running a little above 100,000 jobs a month on payrolls the last 3 months. Do you view that level of job creation as worrying or alarming, or would you be content if we were to kind of stick at that level? And relatedly, one of the welcome trends of the last couple of years has been labor market steam coming out through job openings falling rather than job losses. Do you think that trend has further to run, or do you see risk that further labor market cooling will have to come through job losses?
So on the job creation, it depends on the inflows, right? So if you're having millions of people come into the labor force, and you're creating 100,000 jobs, you're going to see unemployment go up. So it really depends on what's the trend underlying.
People that are part of the trade room, have you heard me talk about that?
There's been quite an influx.
Telling you, bro, all those people that are, all that immigration, right? What he just said, he's basically telling you straight to your face that job openings are on the decline and population of your country is on the rise. So you get a natural rise in unemployment. I keep saying this. You don't even necessarily need people to be getting fired for these numbers to go up. We are literally importing millions of fucking people into the country, and we are not creating millions of jobs. Just do the math. It's very simple math. It's like 2 + 2 = 4, right? That's how simple it is. Powell just literally in just a half a sentence told you that.
It's hard to know that you can't know these things with great precision, but certainly it appears that we're very close to that point, if not at it, so that further declines in job openings will translate more directly into unemployment. But it's been a great ride down. I mean, we've seen a lot of tightness come out of the labor market in that form without it resulting in lower employment.
Thanks, Chair Powell. Edward Lawrence, Fox Business. So we've heard some speculation that you may be going with the federal funds rate to 3.5%, maybe under 4%. And there's basically an entire generation that has experienced zero or near zero federal funds rate. Now, some think we're heading in that direction again. What's the likelihood that cheap money is now the norm?
So this is a question. You mean after we get through all of this? It's just great question that we can only speculate about. Intuitively, many people anyway would say we're probably not going back to that era where there were trillions of dollars of sovereign bonds trading at negative rates, long-term bonds trading at negative rates, and it looked like the neutral rate might even be negative. So there was people were issuing debt at negative rates. It seems that's so far away now. My own sense is that we're not going back to that. But honestly, we're going to find out. But it feels to me and that the neutral rate is probably significantly higher than it was back then. How high is it? I just don't think we know. We only know it by its works.
And one more. How do you respond to the criticism that will likely come that a deeper rate cut now before the election has some political motivations?
Yeah, so this is my 4th presidential election at the Fed, and it's always the same. We're always going into this meeting in particular and asking what's the right thing to do for the people we serve, and we do that, and we make a decision as a group, and then we announce it, and that's always what it is. It's never about anything else. Nothing else is discussed, and I would also point out that the things that we do really affect economic conditions for the most part with a lag. So nonetheless, this is what we do. Our job is to support the economy on behalf of the American people. And if we get it right, this will benefit the American people significantly. So this really concentrates the mind. And, it's something we all take very, very seriously. We don't put up any other filters. I think if you start doing that, I don't know where you stop. And so we just...
By the way, gold back under 2,600 on futures pricing. Gold has now officially erased the entire news move, NASDAQ and YM to follow
My
in a
first question
moment
is,
here.
so very simply, what message are you trying to send American consumers, the American people, with this unusually large rate cut?
Don't worry, though. The news is bullish, though. Don't worry, guys. The news is bullish. Don't worry. Don't worry, right? Don't worry. Rate cuts are good. Don't worry about it. It's okay.
More specifically, the economy's growing
It's
at a
okay.
solid
This is totally
pace.
normal, by the
Inflation
way.
is coming down
It's totally
closer
normal,
to
by
our
the way.
2% objective over time. And
Totally
the labor market
normal
is
behavior
still in
for a
solid
bullish
shape.
market.
So our intention is really to maintain the strength that we currently see in the U.S. economy. And we'll do that by returning rates from their high level, which has really been the purpose of which has been to get inflation under control. We're going to move those down over time to a more normal level over time.
Just a quick follow-up to that. Listening to you talk about inflation moving meaningfully down to 2%, is the Federal Reserve effectively declaring a decisive victory over inflation and rising prices?
No, we're not. So inflation, what we say is we want inflation, the goal is to have inflation move down to 2% on a sustainable basis. And, we're not really, we're close, but we're not really at 2%. And I think we're going to want to see it be, around 2% and close to 2% for some time. But we're certainly not we're not saying mission accomplished or anything like that.
Yeah, just to address chat real quick while Powell rambles on here about the same shit he's already said. Free Zone Lou sold Nas. Yeah, I didn't get into NASDAQ myself, man. I think I'm gonna just intraday trade that. I didn't really like the action. It also never really filled the wick. Let me just pause these people because I don't really care what they're saying at this point. Yeah, it's kind of annoying we didn't fill the wick. I really wanted that 19,900, so I didn't end up taking NASDAQ myself. Again, same thing with the Dow. I wasn't really interested in that. I did tell you guys I sent a trade in the Discord. Obviously, some of you guys know that we took that on gold, took gold shorts. So yeah, rocking in those. Pretty chill in regards to that. Matt says free money. Thanks. Yeah, no problem, Matt. The immigration was the most of what I needed to hear. The long-term plays, and yeah, it's all about the labor market, man. Again, we've been talking about this, and again, some of you that have been here for a while, if you're new, I'm gonna tell you guys now. Again, inflation has not been a worry for a long time. Pretty much since we came under 3.5%, I've been saying, as long as we don't go back above 3.5, it wasn't going to be a problem, and to switch to the labor market. So, again, man, just another example of just us being a little bit ahead. Now everybody's on board. Everyone's been watching the labor market. It's going to be less fun for us, of course. But yeah, man, we're right on track, man. I mean, again, the 50 basis points. Again, I'm surprised they did it. Not from the sense that, I think it was wrong. I kept saying I think they should do it, but, I mean, even the first question, the guy was like, hey, in July, you said, 50 wasn't really, on the table. What changed? So, yeah, it's interesting to see them actually, have some backbone and actually do that. I think it's a strong move from Powell. Again, they're not going to really say anything in this interview now at this point that they didn't already say. They'll find more creative ways to ask the same question, and then Powell will find more creative ways to say the same answer. Wally just tuning in now. Welcome to the party, bro. You a little late, but it's okay. But yeah, Wally, man, they did 50, bro. Could you believe it? Powell, man, he grew some backbone and was like, you know what? We gonna do that 50. I guess we kind of should have anticipated this a little bit more in hindsight, with the Senate asking for 75. Like I said, it was kind of weird for them to ask for 75, especially when the consensus was 25. It's why did you extend this so much further? Maybe they knew, maybe they didn't know. I mean, I'm willing to bet they probably knew. These people are all in the same circle. They eat at the same restaurants and shit. So, they could have had a little play in it. But again, a lot of central banks were also just calling for that 25. So yeah, family, I don't really have much more for y'all. I'm probably going to let this play out. regardless on stream here. But personally, I'll be walking away from my computer. So hopefully you guys enjoy. I'll keep you guys updated on the gold trade that we're in the Discord in the trade room. If you're not in there, there's a link in the bio where you guys can come hang out with us for free. Or you could join the trade room and trade with us live throughout the week. But yeah, love and appreciate y'all. I'm going to let these people talk some more. And I'm going to go enjoy a nice little smoke outside.
The labor market talk earlier, you know, monetary policy operates with long and variable lags. And I'm wondering how much you see being able to keep the unemployment rate from raising too much comes from the fact that you're starting to act now, and that's going to give people more room to run versus just the labor market is strong. And then also, if I could, following up on Nick's question, do you see today's 50 basis point move as partially a response to the fact that you didn't cut in July, and that sort of gets you to the same place?
So you're right about lags, but I would just point to the overall economy. You have an economy that is growing at a solid pace. If you look at forecasters or talk to companies, they'll say that they think 2025 should be a good year too. So there's no sense that the U.S. economy is basically fine. If you talk to market participants, I mean, you know, business people who are actually out there doing business. So I think, you know, I think our move is timely. I do, and as I said, you can see our 50 basis point move as a commitment to make sure that we don't fall behind. So you're really asking about your second question. You're asking about July, and I guess if you ask, you know, if we'd gotten the July report before the meeting, would we have cut? We might well have. We didn't make that decision, but you know, we might well have. I think that's not, you know, that doesn't really answer the question that we ask ourselves, which is, let's look, you know, at this meeting, we're looking back to the July employment report, the August employment report, the two CPI reports, one of which came, of course, during blackout, and all of the other things that I mentioned. We're looking at all of those things, and we're asking ourselves, what's the policy stance we need to move to? It's clear that we clearly, literally, everyone on the committee agreed that it's time to move. It's just how fast do you go, and what do you think about the path forward? So this decision we made today had broad support on the committee, and I've discussed the path ahead.
Thank you, Chair Powell. Elizabeth Schulze with ABC News. Mortgage rates have already been dropping in anticipation of this announcement. How much more should borrowers expect those rates to drop over the next year?
Very hard for me to say. That's from our standpoint. I can't really speak to mortgage rates. I will say, you know, that'll depend on how the economy evolves. Our intention, though, is we think that our policy was appropriately restrictive. We think that it's time to begin the process of recalibrating it to a level that's more neutral rather than restrictive. We expect that process to take some time, as you can see in the projections that we released today. And if things work out according to that forecast, other rates in the economy will come down as well. However, the rate at which those things happen will really depend on how the economy performs. We can't look a year ahead and know what the economy is going to be doing.
What's your message to households who are frustrated that home prices have still stayed so high as rates have been high? What do you say to those households? Well,
what I can say to the public is that we had a burst of inflation. Many other countries around the world had a similar burst of inflation. And when that happens, part of the answer is that we raise interest rates in order to cool the economy off, in order to reduce inflationary pressures. It's not something that people experience as pleasant, but at the end, what you get is low inflation restored, price stability restored. And a good definition of price stability is that people in their daily decisions, they're not thinking about inflation anymore. That's where everyone wants to be, is back to what's inflation. You know, we just keep it low, keep it stable. We're restoring that. So what we're going through now really, it will benefit people over a long period of time. price stability benefits everybody over a long period of time just by virtue of the fact that they don't have to deal with inflation. So that's what's been going on, and I think we've made real progress. We don't tell people how to think about the economy, of course, and of course people are experiencing high prices as opposed to high inflation, and we understand that's painful.
Greg.
Hi, Chair Powell. Greg Robb from MarketWatch.com. I was wondering if you could go through, you said just at the beginning that coming into the blackout, there was like an open thought of 25 or 50. The Fed could move either 25 or 50. I would sort of argue that when we had those two last speeches by Governor Waller and New York Fed President John Williams, that they were sort of saying that maybe a gradual approach was going to win the day. I mean, I sort of want to ask a 7-part question about this, but I mean, could you talk? Would you have cut rates by 50 basis points if the market had been pricing in like low odds of a 50-point move like they were last Wednesday? After the CPI number came out, it was a really small probability of a 50-point cut. Does that play in your consideration at all? Just talk a little bit about that. Thank you.
We're always going to try to do what we think is the right thing for the economy at that time. That's what we'll do, and that's what we did today.
Simon.
Thank you, Chair Powell. Simon Rabinovich with The Economist. You've mentioned how closely you're watching the labor market, but you also noted that payroll numbers have been a little bit less reliable lately because of the big downward revisions. Does that put your focus overwhelmingly on the unemployment rate? And given the SEP projection of 4.4 basically being the peak in the cycle, would going above that be the kind of thing that would trigger another 50 basis point cut?
So we will continue to look at that broad array of labor market data, including the payroll numbers. We're not discarding those. I mean, we'll certainly look at those, but we will mentally tend to adjust them based on the QCEW adjustment, which you referred to. There isn't a bright line. It will be the unemployment rate's very important, of course, but there isn't a single statistic or a single bright line over which that might move that would dictate one thing or another. We'll look at each meeting, we'll look at all the data on inflation, economic activity, and the labor market, and we'll make decisions about is our policy stance where it needs to be to foster over the medium term our mandate goals. Yeah, so I can't say we have a bright line in mind.
Matt Egan.
Thanks, Chair Powell. Matt Egan from CNN. I know that you discussed earlier how the Fed does whatever the right thing is and nothing else factors in. But, in general, can you talk about whether or not you believe a sitting U.S. president should have a say in Fed decisions on interest rates? Because that's something that former President Trump, who obviously appointed you, has previously suggested. And I know the Fed is designed to be independent, but why? Can you tell the public why you view that so importantly?
Sure. So countries that are democracies around the world, countries that are sort of like the United States, all have what are called independent central banks. And the reason is that people have found over time that insulating the central bank from direct control by political authorities avoids making monetary policy in a way that favors maybe people who are in office as opposed to people who are not in office. So that's the idea, is that, and I think the data are clear that countries that have independent central banks, they get lower inflation. And so we do our work to serve all Americans. We're not serving any politician, any political figure, any cause, any issue, nothing. It's just maximum employment and price stability on behalf of all Americans. And that's how the other central banks are set up too. It's a good institutional arrangement, which has been good for the public. And I hope and strongly believe that it will, continue.
Kyle.
Kyle Campbell for American Banker. Thanks for taking the questions, Chair Powell. A couple regulatory developments in the past week that I want to ask you about. First, last week, Vice Chair for Supervision, Michael Barr, outlined his views for the changes to the Basel III Endgame. I'm wondering if you are in alignment with him on what those changes should be, if those have support on the board in a broad way that you're looking for, and if you think the other agencies are also fully on board with that approach. And then yesterday, other banking regulators.
You know what? Hold the second question.
Okay, sure.
Let me we'll give you the second question. So, the answer to your question is that yes, those changes were negotiated between the agencies with my support and with my involvement, with the idea that we were going to repropose the changes that Vice Chair Barr talked about, and then take comment on them. So yes, that is, that's happening with my support.
Okay. And is there a date for that?
That's not a final proposal, though. You understand? We're putting them out for comment. We're going to take comment and make appropriate changes. We don't have a calendar date for that. And as for the other agencies, the idea is that we're all moving together. We're not moving separately. So that I don't know exactly where that is, but the idea is that we will move as a group to put this again out for comment, and then it'll come. The comments will come back 60 days later, and we'll dive into them, and we'll try to bring this to a conclusion sometime in the first half of next year.
Right. And then yesterday there were merger reform finalizations from the other bank regulators. Well, what does the Fed have to do to align itself on merger?
I would bounce that question to Vice Chair Barr. It's a good question, but I don't have that today. Thanks.
Jennifer for the last question. Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said earlier that the decision today reflects with appropriate recalibration strength in the labor market that can be maintained in the context of moderate growth. Even though the policy statement says you view the risks to inflation and job growth as roughly balanced. Given what you've said, though, today, I'm curious, are you more worried about the job market and growth than inflation? Are they not roughly balanced?
No, I think, and we think they are now roughly balanced. So if you go back for a long time, the risks were on inflation. We had a historically tight labor market, historically tight. There was a severe labor shortage, so very hot labor market, and we had inflation way above target. So, that said to us, concentrate on inflation, and we did for a while, and we kept at that. That the stance that we put in place 14 months ago was a stance that was focused on bringing down inflation. Part of bringing down inflation, though, is cooling off the economy and a little bit cooling off the labor market. You now have a cooler labor market in part because of our activities. So what that tells you is it's time to change our stance. So we did that. The sense of the change in the stance is that we're recalibrating our policy over time to a stance that will be more neutral. And today I think we made a good, strong start on that. I think it was the right decision, and I think it should send a signal that that we're committed to coming up with a good outcome here.
Is the economy more vulnerable to a shock now that could tip it into recession?
I don't think so. I don't. As I look. Well, let me look at it this way. I don't see anything in the economy right now that suggests that the likelihood of a downturn is elevated. Okay, I don't see that. You see growth at a solid rate. You see inflation coming down, and you see a labor market that's still at very solid levels. So I don't really see that. No, thank you.
That wraps up a news conference that probably should have wrapped up 15 minutes ago. Live from New York City this afternoon. Good afternoon. For our audience worldwide, welcome to the program, a special edition of Bloomberg Surveillance on a Federal Reserve decision. The decision as follows: a 50 basis point cut with a sprinkle of dissent. Your equity market on the S&P 500 still just about firmer, but rolling over in that news conference. We're now firmer by just 0.25%. On the Russell, still elevated up by more than 1 full percentage point. Straight out of the gate in that news conference, framing policy recalibration, something he said multiple times, a process that evolves over time. Take a listen to what the chairman had to say on the path forward.
I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen. So in the base case, what you see is look at the SEP. You see cuts moving along. The sense of this is we're recalibrating policy down over time to a more neutral level, and we're moving at the pace that we think is appropriate.
Recalibration on repeat. Lisa, looking forward, meeting by meeting, this is not the new pace. That's something he put some weight on, some emphasis in that news conference.
And if you were basically judging his news conference based on the stock reaction, there was a little wobble after that statement, and even more of a wobble after he really addressed the idea of a neutral rate. He called it a sense of neutral, whatever that may be, and he said that my own sense is we're not going back to that Nehru time or that negative rate, very low rate time. Neutral rate is probably much higher. You saw a reaction there, but then people shook it off and said, hey, he's got our back.
I look, John, I strapped a Fibonacci across this from where we were to the midpoint of the pandemic low is 2 7/8. He is correct. It's just a nudge in the distance to travel just to get back to the midpoint, call it normal. It's a lot longer than the jawboning in the press conference that we just saw.
We're lucky to have Mohammed alongside us. He won't say mission accomplished. He refused
All
to
right, it looks like Powell's done talking. I just got back to the desk. Yeah, nothing else to say, family. Been a beautiful stream. Again, for those of you that faded this on gold with me, congratulations. Yeah, we're gonna still keep holding, baby. You guys already know we're looking for much lower, at least below 25.30. Potentially as low as like 24.68, but 90% of you guys in the stream will not be able to hold that long, / probably will give up on trading, / probably don't follow me to get updates anyway. So good luck with your journey on that. Indices have not really moved too much. I guess they're getting a little steam now, maybe. But I'm going to revisit these during Asian session and see if I can find a better price, since they never filled the wick, and they are lame like that. But gold is falling, and we're getting paid, and that's all that matters. So, yeah, hopefully y'all traded well. Hopefully y'all paid attention. And I love and appreciate you guys. Trade safe. Have fun. Don't blow your accounts. This is your boy Skag, and I'm out.